Hello, I'm Sandy Weaver with Weaver Financial. Let's do the numbers. In a nutshell, for the year 2025, both stocks and bonds had outstanding returns. The drama and headlines continued in the fourth quarter. Corporate earnings are quite healthy. Interest rates were cut even though inflation still remains elevated. Tariffs are impacting prices and not only on imported goods. Fortunately, the impact is less than feared so far. At quarter end, U.S. large company stocks roared ahead, returning 18% for the year. Small companies hustled as well, up 13%. Overseas stocks busted the ceiling, up 33%, helped by a weaker dollar. Bonds gave us a 7% return, quite good for a steady investment. Let's start with the U.S. economy, corporate earnings, tariffs and politics, interest rates, overseas, and then what 2026 may look like. 2025's economic growth, or GDP, is estimated to be 1.8%. The estimate for fourth quarter is over 5% per the Atlanta Fed Reserve's GDP Now tool. But recall that the first quarter GDP was negative in 2025 because of the inventory building anticipating tariffs. Consumer spending, 70% of the economy, met estimates at 3.5% for the third quarter. Consumers at the top end are spending. Job growth remains slow. Unemployment data is jumping around, the most recent at 4.4%. The labor pool is oscillating from immigrant laborers being deported, curbs on immigration, baby boomers retiring, and a low birth rate. Corporate earnings are a hit, increasing 12% in the third quarter, estimated at 8% for the fourth quarter, and 10 to 11% for all of 2025. 2026 is estimated at 15%. Corporations are doing well. The US dollar remained down around 9% in 2025. Predictions are mixed for 2026. The good news is that the price hikes initially anticipated from tariffs are coming in lower than anticipated. The bad news is that companies are holding back or slowing down the pass-through, perhaps trying to keep a low political profile. Another impact which we anticipated is that domestic suppliers are taking advantage and raising prices also. After all, if your foreign competitors' brands are pricier now, that gives you, a domestic supplier, room to raise your prices too and increase your margins. Schwab reports that tariffs has raised retail prices by 5% so far. The Supreme Court may throw a wrench into some tariffs based on their ruling expected soon, but pros expect the Trump administration to re-implement tariffs under different structures if the Supreme Court does not expand presidential powers. Inflation remains elevated at 2.7% versus the 2% target. The Federal Reserve cut interest rates on the short end in September, October, and November in 2025. The rate stands at 3.5% now. That lowers the interest you receive on money market funds, but may lead to higher inflation. 1 to 3 cuts are anticipated in 2026. Political pressure from the Trump administration via a DOJ investigation and the attempted firing of a Federal Reserve Board member is high, threatening the institution's independence and credibility. War continues in Ukraine, Russia, but is perhaps calming in Israel, Gaza. Conflicts have expanded to Syria, Iran, Venezuela. These impact markets, the oil companies, and defense stocks, but not as much as you may think. China is a worthy contender and the world's biggest contributor to economic growth now. U.S. trade talks remain mired down in rare earths for semiconductor chips. At 1.4 billion people versus 4 million in the U.S., 400 million, I think that's wrong. China has a bigger engine. They have more engineers, more scientists, and an advantage to exploit versus The Rise and Fall of Nations by Sharma. We've made outstanding returns from international stock markets in 25, partially due to rising stock prices overseas, combined with a falling dollar. Most pros expect another strong year there, given that multiples remain cheaper than our US stock multiples. What does 2026 look like? Price earning ratios usually within a 12 to 22 range historically for the S&P 500 companies remain above that at 25 times a dollar of earnings. Most pros don't think we're in a bubble. Most pros don't think we're headed for a recession. Most pros expect 2026 to be a good year for the markets, but not as exuberant as 2025. Don't forget, the long-term return for the S&P 500 stocks is only 10%. To be sure, a few pros forecast a down year or a flat year for 2026. Most pros are advising diversification and safe corners. Some pros talk about uncertainties, of which we have plenty, and compare that to a growing instability of the system, which we're seeing too. Think high deficits in our robust economy, tariffs removing political leaders, significant gyrations in the labor pool due to immigration changes, and more. Instead of piling into the stocks and high yield bonds that we know gave us the highest returns over the last 3 years, we've inserted even more diversification and quality to beef up the portfolios. Thank you for your interest. Please call or email if you want to dig in further. I'm glad to pass on my readings, podcasts, and the other sources.